What happened to Bed Bath & Beyond? The story might seem as simple as it just didn't work out. Any one piece of the puzzle might seem like a coincidence, but when you start to follow the money and see how much of it ends up in the same places, it makes you start to wonder, why? The story of Bed Bath & Beyond isn't a series of unfortunate events, but rather a heist. There are very few people looking because who the money was stolen from is kind of ambiguous. It's shareholders, it's employees. It would be like if your house got broken into and you followed the muddy footprints to find where all of your valuable possessions were, and someone said it was an accident. Would you believe it? They stumbled into your house and just accidentally collected all the most valuable things and then accidentally left? To assume Bed Bath & Beyond was merely just a failed business plan, that great executives tried everything they could do to save but couldn't, is just not true. All the important things in a company happen behind closed doors. Shareholders can be like victims in Plato's cave, where they're tied down and all they get to see are shadows on the wall. But when you really start looking at those shadows, you can figure some stuff out, especially if you follow the money. In the case of Bed Bath & Beyond, there was a lot of money that moved around. At least tens of billions, potentially a lot more. What I'm going to say is speculative, and I'll say it's all allegations, some of it more substantiated than others. I think the story starts back in 2014.
Your punishment must be more severe. Surely you've heard of Bain capital punishment.
Yes.
Where this economy is ashes. You'll have my permission to die.
This is probably the most speculative part of it. Bain Capital, McKinsey, and Boston Consulting seem to have a lot of involvement with the demise of Bed Bath & Beyond as far back as 2019, and also have a lot of connections to the companies who ended up with the market share afterwards and the properties that were sold. When you look at who they work with and how much they would stand to gain, you can't help but wonder. Amazon, Microsoft, World Economic Forum, Wayfair, Meta, Google, Salesforce. You can see that they're clearly moving towards online retail, and big box stores like Bed Bath & Beyond get in the way. I believe this is where the plan was hatched. Like any financial fraud, this is a Ponzi, and the Ponzi goes like this. You have people lend you money up front. Let's say a bond, $1,000 bond, which pays interest. You take the money up front, you start paying the interest, and the goal is to never have to actually pay the whole thing back. You get more and more people giving you money. You sell more and more bonds. And if the company goes bankrupt, you never have to pay them back. Where you buy something, you get it evaluated higher than it should be. You gut everything of value out of it. You buy insurance on it, and then you burn it down, collect the insurance, and move on to the next scam. In this scam, there's lots of victims. The bondholders, the shareholders, the employees, and you can see which companies they targeted by the appearance of these tokenized shares on the blockchain. That's crypto-based, supposedly one-to-one backed securities. We wonder who invented the meme stock. Was it Ryan Cohen? He might have perfected it, but really who invented it must have been institutions, because they were trading all the way back in 2019, long before Ryan Cohen entered GameStop. Billions of these tokens were trading. Why they were trading? I don't know. That's one of many things that happens behind closed doors that we don't get to know about. I have a few speculations. One is used as collateral on a balance sheet. If you short sell a stock, you borrow a stock, sell it onto the market, and then pay it back later, hopefully at a lower price to make money. There's many reasons you would do that. One is that you don't have to pay taxes until you cover your short position. And if the company goes bankrupt, you never have to pay taxes. And two, it's a lot easier to bet against something, to destroy it, than to build something of value. In order to borrow a stock and sell it onto the market, you have to have margin. You have to have room in case the price of that security goes up, at which point you would have to buy it at a higher price. You would lose money. It's possible they were using these tokenized shares on their balance sheet to look like they had shares of companies at that time that were doing well, like Bed Bath & Beyond or GameStop. Or these tokenized shares could have been used as locates in order to borrow. There's many other reasons they could have used them, none of which are transparent and should be looked into. When you look at the players using these tokenized shares, conveniently, they all have the same accountant, which is PricewaterhouseCoopers. We saw a glimpse of the problem of these tokenized shares with the collapse of FTX. We heard about losing Bitcoin and Ethereum, and very few people talked about these tokenized shares, but there was actually billions and billions of dollars worth of tokenized shares of A.M.E, Bed Bath & Beyond, and GameStop. That was the first step. The next step in the typical mafia shakeout is to extract all the value. At this point, they use proxy solicitors to get the votes. People like Vanguard, BlackRock, all these people that have big mutual funds, they can take your vote and they can put whoever they want on the board and control compensation or however the company uses their money. In the case of Bed Bath & Beyond, they elected Mark Triton to the board. And from day one, he did everything he could to destroy all the value in Bed Bath & Beyond. He installed a Boston Consulting Group e-commerce solution, Blue Yonder, which for some reason didn't do well during COVID when Wayfair did really well. Probably a coincidence, right? He began using the whole $1.5 billion cash on hand that Bed Bath & Beyond had for share buybacks. He sold all the properties which were worth $1 billion for $250 million to people he seems to be connected to. He then used that money for more share buybacks, unbelievably. It probably isn't a coincidence, though, that in 2020, they got rid of their dividend, but kept doing the share buybacks. If you couldn't afford the dividend, how could you afford the share buybacks? It doesn't really make sense, right? Unless people have been short selling the stock or naked short selling, which is just counterfeiting shares, and they didn't want to have to pay the dividend. Because if you counterfeited a bunch of shares, if you had a bunch of IOUs floating around and those shareholders thought they had real shares, when that dividend came up, you'd have to pay it. So if you printed double the shares or triple, you'd have to pay all those dividends out. And it'd be very apparent that you counterfeited. So they got rid of the dividend, but kept doing share buybacks. Then one by one, they started selling off all the valuable subsidiaries, like Christmas Tree Farms and World Market. When you look at the properties that were sold, the same people that bankrupted Toys R Us by selling their properties and leasing them back at inflated rates somehow were there. KKR, Bain Capital, Blue Owl, and Oak Street, which have connections to the Council for Foreign Relations and Sigma Kappa for some reason. At this point, all the cash is gone, all the properties are gone, and it's being saddled with more and more debt. Similar to Toys R Us, where they pulled out $5 billion worth of bonds that they never had to pay back in full. All the way back in 2014, Bed Bath & Beyond took out billions of dollars worth of bonds. So now saddled with debt, the company needed money to be able to fill their shelves for Christmas. And what did they do? They got a loan from JP Morgan. And part of that loan, that $500 million ABL loan, was a lien on the company and the ability to do cash sweeps whenever JP Morgan wanted. This prevented Bed Bath & Beyond from being able to fill their shelves 2 years in a row. This is when Ryan Cohen comes to the scene to try and unlock the value and save the company. He bought 10% of the shares and wrote a letter to the board. The executives of the company have a fiduciary duty to the shareholders. They're not supposed to promote their own interests, but the interests of the shareholders. And so defending their position on the board at the expense of the company is illegal. Ryan Cohen at that point had 9.6% of the company. This was in March of 2022 when Bed Bath & Beyond had no money, completely saddled with debt, and saw Ryan Cohen with the intention to purchase Bye Bye Baby, which would have unlocked value for shareholders. And what Mark Triton did was he did $40 million worth of share buybacks to push Ryan Cohen past 10% so that he'd be an insider, so that he couldn't make an offer on the company. The share price went up due to the share buybacks, and Ryan Cohen decided to take an alternate route to pursue Bed Bath & Beyond, which was to make an offer on the company. So he sold his position so that he would no longer be an insider. This was Ryan Cohen's only way forward with Bed Bath & Beyond. However, ironically, he was accused of a pump and dump. Meanwhile, there was a real person doing a pump and dump who was Jake Freeman. He bought, right before the run-up, a bigger position than Ryan Cohen and sold at the top. Not only that, but wrote a paper with his university in connection with Credit Suisse about how to bet against a company holding the bonds hostage and to guarantee that you'd make money. So he bought at the bottom, shorted from the top, but not only that, bought insurance or total return swaps against the bonds. Meanwhile, holding the bonds to be able to veto anything that would save the company. Jake Freeman made over $100 million just on the run-up, but it's very possible that he made a lot more than that betting against the company. So there's two main characters, Ryan Cohen betting for the company and the shareholders, and Jake Freeman betting against the company and trying to take the company into bankruptcy. Ryan Cohen around this time made an offer to buy Baby. Meanwhile, the law firm Clearly Gottlieb comes to the scene to suggest a bond swap with convertible bonds that after a triggering event could be turned into shares. This is very dilutive. This deal was resisted and finally denied in the beginning of 2023. At that same time, mysteriously, the stock starts trading on the Austrian exchange, and millions per day of fails to deliver start showing up in the stock, which is direct evidence of naked short selling. Though the convertible bonds were rejected, it didn't stop B. Riley and Hudson Bay from coming in and doing preferred A shares, which do the same thing, dilute the company. Hudson Bay sold as many shares as they could, as fast as they could, even though they weren't supposed to go past 10% ownership, which would be a 16B violation. I think that's because they had already sold them. They were already fails to deliver from long before, where they sold it at a lot higher price. The new CEO, Sue Gov, then does a public interview saying that she has a plan to save the company, to reduce the footprint, and shed toxic debt. All that needed to happen was a reverse split needed to be approved, but once the vote was collected, they voluntarily went into bankruptcy anyway. We saw people from B. Riley, who were bondholders, trying to block any sort of sale that would save the company. Through just short selling alone and the fails to deliver, tens of billions of dollars of value was taken from the company. It's very likely that much more than that in total return swaps was also taken from the company, and those bets are still out there. The story's not over though. Recently they just found fraud on the board, and they're starting to untangle this mess. All the transactions up to 90 days before the bankruptcy can be clawed back, and we'll see what happens. I think things will get very interesting.